So, at first glance, Lanka IOC's latest results, they don't look great. The headline numbers show a pretty big profit decline, but trust me, that is not the real story here.
And this is where a lot of people would probably stop, right? A 16.2% drop in net profit year over year looks bad, end of story.
But that income statement, it's hiding something. While profits were down, the company was actually generating a record amount of cash.
Okay, and this is where things get wild. This is their cash conversion ratio. For every single rupee of profit they reported, they were pulling in nearly 4 rupees in actual hard cash from their operations. That's just an incredible number.
So that leads us to the big question here, the real puzzle we need to solve. How on earth can a company's cash flow be almost 4 times its profit, especially when that profit is falling? This is fundamental analysis for educational purposes, not financial advice. All right, so let's start by looking at the profit problem. We need to unpack that income statement to see exactly where the bleeding was. You can see it right here. Revenue took a hit, down 9.4%. And even though their gross margins were okay, other expenses started to creep up. That's what squeezed the operating profit, pushing it down by over 18%. So there's your negative headline.
But forget the income statement for a second. The real story, the brilliant move, is happening over on the balance sheet.
And here's exactly where that cash came from. Look at this. They made a conscious decision to turn their assets into cash. They sold off a massive 15.7 billion rupees worth of inventory and went out and collected another 5.3 billion in payments they were owed. Just like that, they converted stuff sitting around into cold, hard cash. It was a really clear 3-step play. First, get rid of inventory. We're talking a 36% reduction. Second, chase down every single receivable. And third, put that new cash to work immediately, paying down debt, investing, and giving some back to shareholders. And the result? Well, look at this. They've built an absolute fortress. The company is swimming in cash with a current ratio over 3. It's basically debt-free. And get this, its book value, its net asset value per share, actually went up, even after paying a dividend. Okay, so what can we learn from all this? This whole situation gives us 3 really important lessons for anyone who wants to look deeper than just the headlines. Lesson 1, and this is the big one, cash is king. It's the lifeblood. That ability to generate almost 20 billion rupees in cash, even with profits down, shows that the company's earnings are incredibly high quality. Lesson number 2 is all about how you look at working capital. Stuff like inventory and receivables. It's not just a line item on a spreadsheet. It's a pool of cash waiting to be unlocked. Lanka IOC showed exactly how to do that strategically to create a ton of value. And that brings us to lesson number 3, which is maybe the most important of all. It's one thing to know a company is making money, but you absolutely have to know how they're making it. And wow, check this out. This is a huge deal. Almost half, 46%, of Lanka IOC's net profit didn't come from its main business of selling fuel. Nope. It came from interest it earned on its investments. Now, this creates a pretty significant risk. We call it finance income dependency. Sure, that income is boosting profits right now, but it's not stable. It's completely at the mercy of interest rates. If rates fall, their net profit could get hammered, and that would really expose the weakness in their core business. All right, let's put it all together. What's the final verdict here? What we have with Lanka IOC is a fascinating story of 2 halves. On one side, you've got this financial fortress. The balance sheet is just bulletproof. But on the other side, you have a real growth problem. Revenue is down, margins are getting squeezed, and they're leaning heavily on that finance income. Look, management has done an incredible job here. They've engineered a masterful pivot to make the company leaner and flush with cash. The balance sheet is stronger than ever. But they did it by shrinking. So the big question, the one that defines their future, is this. Now that they have all this financial firepower, can they actually use it to get their core business growing again?